But I do think that we are very close to an inflection point with respect to the markets, where we may go back to when I was a child and Treasury secretaries had to worry about deficits. They had to worry about the dollar and whether or not the markets were going to come and buy our debt when we ran an auction. Those were desperate times, and they brought serious, purposeful people forward in American life. We'll have the same thing happen again. I'm very sure of it because, we're one Treasury auction away from a problem.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest wrote the book, Inflated, How Money and Debt Built the American Dream. And in it, he wrote, quote, "The first rule of any fiat system is no fiscal deficit." Well, the US and virtually every other G7 country is breaking that rule 6 ways to Sunday, given the unprecedented record levels of deficit spending currently underway. Does that mean we're headed for trouble? To find out, we'll ask the author himself, Chris Whalen, chairman of Whalen Global Advisors LLC and expert on the banking, mortgage finance, and fintech sectors. Chris, thanks so much for joining us today.
My pleasure, Adam.
Hey, Chris, it's my pleasure too. This is the first time I've been interviewing you. It's a privilege. Thank you for coming on. I got a lot of questions for you, some very topical to things that are even happening today. But if I could just start by asking you the general question I like to ask folks at the start of these discussions. What's your current assessment of the global economy and financial markets?
I think the global economy is stable, but heavily encumbered with debt. And this is, the result of a long, peaceful, and relatively stable run by most of the industrial countries. And then, of course, most recently joined by China. It's arguably probably the most important nation in the world after the US economically. So it's not a bad prospect we face at the moment, but we face the old problems, which is that when societies can't meet their immediate needs with taxation, they borrow. And then eventually that gets out of hand. So here we are. We're repeating the American experience over and over again every 100 years or so.
All right. So when you say we can't meet our needs, sustainably, so we have to borrow against the future, and that can get out of hand. Where are we, would you say, on the out of hand meter? 0 being fine, 10 being chaos.
We're about a 7 right now. And it's not that we couldn't fix the current problem, the $36 trillion in debt and Social Security and the rest, but it assumes a certain degree of purposefulness and focus that we don't see in Washington. Washington is doing what it always does, which is essentially looking for the highest bidder. I'm reminded of the debate after the Civil War when the Silverites out west and William Randolph Hearst all wanted the Treasury to buy silver. And eventually they got enough votes to do that. And that inflated the US economy for decades until World War I. In fact, I think the impact of that inflation actually led to the Great Crash in 1929. Wow. So the politics of inflation are very powerful. And after Lincoln, when we realized that we could do things by borrowing, which before the Civil War was just unheard of, then all of a sudden new vistas opened up for the political class. That's why it's important.
Okay. Well, I can't help but think of the Cheney quote, deficits don't matter. We've seen borrowing just explode over the past, well, really over my lifetime. I'm about to turn 53. I'm about as old as the fiat dollar. Nixon closed the gold window like a couple weeks after I was born. And if you look at a chart, we started borrowing at a much faster rate than we were growing GDP starting at that point in time. And now it's just, off to the races. Is this, I mentioned this a lot, and I'm curious if you think the same way. Human nature generally tends to follow, a predictable path where rarely, unfortunately, do we sit down in advance, think about what we're doing, project it out, and say, this is going to have a bad end. I need to change my behavior today to not have a bad tomorrow. Instead, we just keep doing the same thing until the pain of continuing the status quo starts to get more painful than the pace of change. And the example I like to mention is most people don't really change their eating and exercise habits until that first heart attack. And then they say, okay, I guess I better get serious now. Do you see us sort of following that same course on a debt basis going forward?
I do, and for exactly the reasons that you articulated, America always does the wrong thing until we have to do the right thing. And that's just a
Classic Churchill
function of,
quote.
that's right, that's a function of democracy. But I do think that we are very close to an inflection point with respect to the markets, where we may go back to when I was a child and Treasury secretaries had to worry about deficits. They had to worry about the dollar and whether or not the markets were going to come and buy our debt when we ran an auction. We haven't had that for a long time because the world became so dependent on the United States and on the dollar. So in a sense, the demand for the dollar, the demand for American liquidity is no longer just a national issue, even though the Federal Reserve Act is largely silent on international aspects of monetary policy. The demand for the dollar offshore is one of the most important questions we have. I don't know if they talk about it at the Fed table because, again, there is no international mandate for the Fed. There's barely any powers for the Fed. Most of it rests with the Treasury. So, you know what I mean? It's interesting to ponder this because the Chinese, for example, use the dollar to finance everything. There are dozens of countries around the world, including where my wife is from, Uruguay, that are indexed in dollars now. All of the professionals, real estate transactions, everything is dollars. So that demand function for dollars, I think, makes the Fed's job difficult. And I also think the natural tendency to borrow and inflate, much as we are today, right, tends to make everything bigger. So the US banking system's doubled since the 2008 financial crisis. Think about that, what that implies for inflation. Was that natural growth in the US economy? No.
No. All right, I want to get into all those topics with you, the banking system, inflation. But right there, you're talking about the Eurodollar market, which is substantially larger in size than the supply of dollars inside the US.
Yes.
And it's not something the Fed has control over, as you're saying here, right? And on this channel, Brent Johnson comes on a fair amount of the time. I'm not sure if you're familiar with him or not, but he's got the dollar milkshake theory. So he's one of the guys who's banging this drum about, hey, when you're trying to understand the dynamics of the dollar and everyone's saying the world's de-dollarizing and the dollar days are over, he's like, you're totally missing the elephant in the room, which is the Eurodollar market. Sounds like you think that's a very important thing to keep your eye on too.
Oh, sure. Whenever I show clients or I'm writing about the Fed, I always put the swap curve on top of the Treasury yield curve because that's the foreign demand. And it goes out to 50 years. You could do 50-year swaps, fixed to floating rate swaps in dollars. So that's a vast market, the fact that it's deep enough to support that. And I think it's an important market. The US should encourage it. But going back to that quote you read, that's actually a new quote that I'm putting in the updated version of Inflated for next year. You can't have too much leverage in a fiat system because the leverage is already baked into the currency. That's the issue. And what is America about? If you really think of it financially, it's about layers of leverage. We started with hard money, then we started with paper issued by private banks. Then we had Lincoln with his greenbacks, and he created national banks to buy them, gave them other advantages. We need, the textbooks say that national banks were created to strengthen the currency. No, they weren't. They were created to fund the Civil War. Mm-hmm. So each time the government had a need or an exigency that was too big to present to the taxpayer, or in the old days, it was tariffs. We didn't even have income taxes. The government essentially goes out and prints its own money. This is an ancient problem that goes back to Greece and Rome, but it's nice to see America is consistent.
Well, okay, so when we look back over the course of history like that, it really is a story of debt that gets out of control, and the casualty, the ultimate casualty of that from those empires is the currency, right? The purchasing power of the currency dies. Um, so when I asked you earlier, you said we're kind of like a 7 of 10 of this beginning to become a problem here. Um, well, I guess break it down for us as you look at the world right now. What are you watching most closely in terms of the dynamics here that are in the driver's seat, at least for the next couple of years, for investors? What should we worry more about, or what should we be paying more attention to? I shouldn't say worry, because maybe there's big opportunity here. But is it the debt levels? Is it the interest rate on the debt? Is it just deficit spending? We're spending at wartime levels right now, even though we're in
Yes.
peacetime. What are you really? What's occupying your focus right now?
Well, if we're going to run deficits of the size that we're currently running, then that means the economy is going to run hot. We are augmenting aggregate demand by borrowing a lot of money. And the size of this, which is cash that is parked at the Fed in what's called the Treasury General Account, is now so big that it's literally dragging the markets around like the tail on the dog. And to have Treasury as the largest single sector in the US debt markets is not a good thing. You never want to have government that large. If we were funding all of this with taxes, you wouldn't see any of this. They would have cash balances at the Treasury, right? Which are kept at the Fed. The Fed sterilizes them. They actually put Treasury bonds up against the cash that they hold. But it wouldn't have the impact that we're seeing today, which is every time we go into a major refunding, as we will later this year in the fall, and Treasury goes out and raises $800 billion, that has a huge impact on the markets. So I worry about that because they are now the source of instability in the whole system. And I think just the relative size of the Treasury's debt and the operations around it, the cash operations, is something that should be front and center, but it's not. Americans will talk about anything else.
So sorry to interrupt, but can you just sort of clarify for folks what has changed? What's it doing differently now, or what scale is it doing things differently that it didn't do in the past?
The size is the real issue. When the deficit is of such enormous size, approximating 20% of federal spending, and they have to go out and borrow that every month in the bond market, usually with short-term debt. Most of this is front-loaded. They're basically using T-bills to finance the federal debt, which I think is bad policy.
Right.
But,
And expensive.
yeah, going back, frankly, 30 years, the Treasury has decided to fund everything short-term because they thought it was the right way to do it. They thought it was good discipline. But, honestly, Adam, we should have been putting out a lot of 30, 40, 50-year debt during COVID when
Right.
rates were at zero. And I do think we need to manage Treasury a little more aggressively and a little more astutely in terms of issues like this. But, at the end of the day, we can't have a government that is this big and that has such a huge need for funds. That's why, at the very least, even if we don't attack the deficit or the debt, directly, we got to get that deficit down and perhaps even have a slight surplus, just so that we're no longer adding instability to the system. That's my big concern. Because I'll give you another technical issue. The VIX, which is the big symbol of volatility on Wall Street, at the current time, it looks very low, but that's because the correlation between different stocks is low. The volatility of those stocks is actually quite high. I follow banks. Banks have been moving around a lot. You wouldn't think so, but they have. So there's an underlying risk here of volatility as soon as the markets get surprised again. That's the thing I really worry about.
Okay, so it sounds like you think there's a sleeping volatility dragon that's
a surprise. A large real estate company rolls over, or a REIT. The creative destruction going on in commercial real estate now is episodic. It's enormous. And many of these situations are also idiosyncratic. They have nothing to do with the economy or interest rates or anything else. They're very particular. You can have one of those roll over.
I want to talk with you more about that because I also want to talk about the banking system, and commercial real estate is it is a shoe that is dropping on the banking system right now. We want to see how big that is, but let me just get back to Treasury for a second. So if I heard you right, Treasury hasn't really changed its behavior all that much. It's just that the scale has become so big. As you said, it's now the tail that's wagging the dog here. I don't think you love the Treasury's playbook, but they haven't changed it that much over the past 30 years. So you said, look, we need to do is we need to get those deficits down, ideally maybe even get back to surplus. Okay. Some people might roll their eyes and say, all right, Chris, and we should all, wish for, Santa Claus to bring us a pony, right? It's difference between should and would, right? And my question for you is what do you think is the likelihood of us getting the deficit under control and perhaps even getting back to surplus? Is that something that you think anybody that's involved in the current power structure is willing and has the ability to pursue, or is that something that's going to be forced upon us by a breakage in the system?
I think much like the 1930s, it's going to be forced upon us. The current, I always think of probably the last federal legislation that resulted in pain for members of Congress was fiducia back in the 1990s. It was a very tough law. It dealt with the resolution of banks and a lot of other issues at the end of the S&L crisis. Half of the members of Congress who voted for that law lost in the next election. They were just annihilated. So it's been a long time since Congress has done anything vaguely creative or courageous. And I think that's what we're really looking for. It's very similar to what you saw in the 1920s, a century ago. You had a bunch of clowns in Congress. But by the early 30s, the serious people who knew that the country had a problem were taking over. And then you had people like Jesse Jones at the Reconstruction Finance Corp, Al Crowley, the man who really designed and served as first chairman of the FDIC. Those guys restructured the entire U.S. economy. These were very serious people. Nobody argued with Jesse Jones. He was like Jesus Christ come to earth, and he literally, if you couldn't raise money, he'd put you in jail if you were the officer of a bank. So, those were desperate times, and they brought serious, purposeful people forward in American life. We'll have the same thing happen again. I'm very sure of it because, we're one Treasury auction away from a problem. Last year, Janet Yellen actually had to trim her sales at one auction. She had to reduce the amount of 10-year debt that they were selling because the dealers told her, no, not at the price you think you're going to sell it, right? So if that starts to get a little bit unstable, and if Treasury is forced to back up in terms of yield on their securities, then we have a problem, right?
Gosh, so many ways I want to pull on this. Real quick, do you feel like we are, you said earlier, when people could tell that the system was in danger of going off the rails, serious people started getting involved in politics, and then they got thrust to the forefront once the crisis arrived.
Yes.
Do you sense that we have serious people starting to get involved and that they will be catapulted by events, or are we not even there yet? Right? Does the system need to get even worse right now?
I think in private, when you talk to people both in this administration and in the Trump group, they understand that there are issues, but they're also still playing to the voters. And so if you're Donald Trump, do you want to see your tax cuts go away? No. But on the other hand, the tax cuts didn't generate the revenue that we were hoping and expecting, right? So the only way we can start fighting the battle against the debt is to let them expire. Now, that's not popular, is it? But, we have other choices. I think eventually we'll consider a national sales tax. It's been discussed for many years. We have to do something with income taxes. But these are all issues that assume a consensus and that assume that there's more people interested in the solution than there are people out just trying to get attention for themselves. And unfortunately, as you know very well, Adam, the last decade has basically been about politics and showmanship.
Yeah.
So, we have to get things to the point where taxpayers are screaming at their members of Congress and saying, I can't deal with inflation anymore, guys. And by the way, I do think that's the big issue in this election. Even though the media doesn't cover it, they refuse to cover it. I got to hear Mark Halperin talk about this, by the way.
Oh, you did? How was that?
Oh, it was awesome because he said, look, the left thinks by not covering these issues, they're helping their candidate, but they're also not informing people about what voters care about. And I think that's absolutely on target. When I travel, cost of living is top of everybody's agenda. Very definitely.
So every poll I've seen in inflation / cost of living is at the top of the voter issues that they're going to vote on by a long shot too. It's not even close.
Well, it's
Yeah.
come and gone in American society. We have rent control in New York City because of inflation, going back to World War One.
Hmm.
So many people left the farm and moved into the cities during that period. It was like 10 to 1, and never went home. So the demand for housing, demand for other services in the major cities just skyrocketed. And that's why we had the sensitivity to inflation in the old days. Even Jimmy Carter, God bless him, was horrified by inflation in the 70s. This is a Democrat from Georgia. But the old fashioned perspective of the South, the hard money perspective, really was like, oh my God, double-digit inflation. How can that happen? So it's got to bubble up to the top of mind, Adam. That's what it has to do. That's when the country will focus.
So I don't disagree, and I've interviewed Neil Howe, the demographer of the fourth turning on this channel a lot, and he basically says, yeah, that's classic fourth turning, right? Where things just kind of build up and build up until you get some sort of flashpoint or breaking
But
point.
he's right. It's a school of fish. We have to wait until they
turn. So when I talk about this on this channel, the question that I get from folks all the time is, well, when? And nobody knows, so I'm not going to put that pressure on you. But I do like interviews I was doing pre-2020, right? I still was talking about the double-digit jump in certain costs of living, like healthcare and whatnot, right? I mean, I remember marveling back then. Wow, I don't know too many people who could absorb a 10 to 15% increase in their medical premiums or whatever, but we were seeing that in certain parts of the economy. Well, now, post-COVID, Truflation reports that inflation since January 2020 is up by over 25%. And honestly, most people, when I mention that stat, say that feels too low, right? And now we're getting these, citizen journal and sleuths that are going out there now, and they're finding receipts from 4 years ago and then mapping them to what they cost now. There was some guy who's all over the news now who ordered his groceries through Walmart, and Walmart keeps your order, so you can just hit a reorder button. It'll reorder the same basket of goods. He did that, and it was up over 400%. I'm not entirely sure that my grocery bill's gone up over 400%, but maybe closer to that than 25% over the past 4 years.
Two big things that many people know, but they don't think of immediately. Real estate taxes, because home prices have gone up so much.
Yep. And insurance. Yeah.
Especially in states where, storms and other natural occurrences are a problem. But, insurance in Florida is more than doubled.
It's crazy. I live out here in California, and you've got insurance companies that have just abandoned the state, like State Farm.
Allstate, yeah, and State Farm. And the reason, it's not that they won't come back, it's just that right now they don't know how to price it. The prices move so much, and they in turn can't sell that risk into the secondary market offshore, where a lot of insurance companies, will buy risk from an Allstate or buy risk from a Chubb to help them manage their own. So none of them know how to price hurricanes anymore. And that's the problem. It'll sort itself out, but the prices won't come down very much.
All right, great points, Chris, and that provides a great segue into a question I wanted to ask you just about your general inflation outlook. Real quick before I ask it, just to give folks complete transparency, as you were answering that last question, my internet went down. Turns out that Comcast was doing work in my neighborhood and didn't tell anybody, and so I was without Wi-Fi for the rest of the day. So you've kindly agreed to come back on and finish this conversation, which is why you're wearing a different shirt than you were. So I just didn't want it to be jarring for folks. But thank you for being so kind and flexible, Chris. So to your point there about insurers don't know how to price insurance anymore, and it's largely due to inflation, right? When the home prices run up in value, yeah, that's great if you're a homeowner. But then your insurance goes up, as people are learning right now. Your property taxes, which are based on the assessed value of your house in most states, go up. Repairs and maintenance go up. So it has this ripple effect. That's what's so nefarious about inflation, is it gets everywhere. It impacts everything. So to the spirit of that question, where do you see inflation headed from here? Especially because, we've had the wealthy, they've been pretty inured against this recent spike in inflation, because yes, their cost of living's gone up, but so have the value of their financial assets. But financial assets aren't equally owned. They're owned by the wealthy households that own them. So the bottom 80% has had to absorb all the cost of living without much other relief. Their wages haven't kept up. So where do you see inflation going from here?
Well, I think in a monetary sense, we have inflation embedded into the mix because, if we're going to finance 20% of spending every year, that's going to make the economy run hot. So prices will tend to continue to rise. Then you have things like housing, and we have a supply constraint. There aren't enough homes being built, and people forget this, but obsolescence takes out a couple of points of housing assets every year because the houses just don't function anymore. They have to be knocked down and replaced.
It's a depreciating wooden box.
Yeah. So on the one hand, you have an inflation bias in the economy, but on the other hand, and this is the thing that really concerns policymakers, the amount of debt that the economy is carrying today, both public and private, tends to be a deflationary factor in the mix, and they worry about that because if you think about it, from the Great Depression through World War II, the globe was really deflating. We didn't have an inflation problem because we had overcapacity, we had people who couldn't work. So it took a long time and a lot of spending on the part of the United States after World War II to make inflation a problem again. Then we get to the 70s and we have the Humphrey-Hawkins law, which is what enshrines the dual mandate the Fed follows today, employment and price stability. And that was a political arrangement. They wanted to guarantee jobs for everybody in the country, and the Republicans said no. So Humphrey-Hawkins was the compromise. But having said all that, you can't legislate low inflation and you can't legislate full employment. Those two things don't really function. So at the end of the day, we have a society which assumes inflation and benefits from it, home prices, stocks, etc., right? But the bottom of society that doesn't have access to those things like home ownership and owning equities get killed. And particularly if you look at the bottom third of households in the US since COVID, they're the ones who've been taking the beating. If you own stocks, if you owned NVIDIA, you're happy. If you happen to own a home, the home prices doubled in many parts of the country. But that's the irony, and I think the ambiguity of America, which is that on the one hand, we pretend to be prudent, we pretend that we can, keep inflation under control. You saw Jay Powell out yesterday talking about inflation. But what we do with our fiscal policies and other policies actually encourages inflation. Think about commercial real estate. Commercial real estate has gone up in value for the last 100 years. Every little community bank I raided when I was at Kroll had portfolios of multifamily apartment buildings that had never gone down. They rolled them every 7 years, and the owner would take cash out sometimes. Now we have the opposite, which is the owner of that apartment building may have to put cash in when the mortgage comes due. That dynamic change in the entire commercial real estate market in the United States is a big deal. It really is. You could almost say that a minimum of 2% inflation is what we need for commercial real estate.
It's a stretch
seriously, because if it doesn't go up, if you're the bank, it becomes more difficult to finance it. You saw this with the failure of Signature Bank. The FDIC still owns most of the rent-stabilized assets from Signature Bank. They can't sell them. And obviously, from a progressive perspective, they don't want to sell them, because it would show what the cost of rent control really is. So, there's inflation is an American tradition, one way and another, is the way I would put it.
All right. Well, look, you just opened the door to another question I want to get to, which is the stability of the banking system. But let me try to get there through this inflation question, which is, we just talked about how I'm going to call them the bottom majority, because I do think it's somewhat of a Pareto rule here, where you got 20% of the country that's doing fine, 80% that's increasingly struggling.
Mm-hmm.
We are a 70% consumer spending GDP. We seem to be seeing increasing signs that the consumer is tapping out. At least that bottom 80% is having harder and harder times. And we're seeing, retail sales, really begin to flatline here. We're seeing households taking on an accelerating amount of debt, just trying to keep their lifestyles going. We're seeing the explosion of services like buy now, pay later, just trying to keep this thing limping along, all that type of stuff. We had GDP growth. I think the final adjusted number was what, 1.4% for Q1. Q2 has been bouncing all over the place the way that it normally does on GDP now, but it's now taken another downturn. I think it's now like 1.7 or something like that. So the economy seems to be slowing compared to where it's been for the past year and a half. Is there a concern? What is your level of concern that we may be slouching into an economic slowdown here?
Well, I think the slowdown is inevitable because of the large magnitude swing in interest rates. You could argue today, Adam, that interest rates are normal for the first time in 20, 30 years.
Right.
The economy is not having trouble with Fed funds in the 5% range. But at the same time, the change over the last 5 years compared to where we were during COVID, when the Fed essentially embraced inflation as a tool for addressing an external event. Nobody anticipated COVID. Nobody anticipated millions of Americans being sent home to work from home if they could. And many of them needed forbearance on mortgages or forbearance on rent. And that cost a huge amount of money. You see it in the federal debt. You see it in other areas. And with the banks, what's happened is the assets that they created or that they purchased during 2020, 21, 22 have such low coupons that today they're sitting with losses on government securities, Ginnie Mae mortgage-backed securities, which are 100% backed by the US government. And yet those securities are trading 15, 20 points below where the bank bought them. And so they can't sell them without taking a loss. I'll give you an example. Goldman Sachs, Morgan Stanley have securities portfolios that basically have yields that are below their cost of funds today. Both of those banks pay a lot more for money than, say, JP Morgan and Wells Fargo. Now, they don't have a big problem here, but they're certainly not making money on their investments in treasuries and mortgage backs. They're losing money. And in fact, the whole industry is only making 3% on their investment securities today. That's because they bought them a couple of years ago. So obviously, that's not a good way for the bank to make money right now. The loans are better. And over time, we're going to fix this problem. But the trouble is that right now, we're also talking about commercial real estate and consumers and everything else perhaps becoming a problem next year. If I've already got a balance sheet that's got a lot of low coupon bonds that I can't sell, it limits my flexibility in dealing with other issues. And I've written about this in some fairly grim terms recently in the blog, and a lot of regulators reached out to me and said, "You're right, Chris." And they're worried about it. I can tell you at the very top of the House, policymakers in Washington are very worried about the banking industry, not so much because they're going to fail tomorrow. That's not the issue, but because they could have subdued or really muted earnings and revenues going forward, simply because they get a hedge fund to come in and take some of the risk and take also some of their future income away, or they sit with it. Bank of America is a great example. Brian Moynihan makes less than 3% on $840 billion worth of investment securities. Brian's paying more than that for money today. Right. So that's really where the industry is. I would say that they are going to have to just dig their way out of this. I don't expect a lot of banks to fail. You'll see a lot of mergers, though. You will definitely see consolidation as a result of COVID.
Okay. So let me ask you this. This idea that popped in my head as you're talking about here is, I just mentioned some challenges to economic growth in the context of the banking system, as you just outlined it. The banks are compromised to lend, right? In other words, they've really got to tighten their lending standards because they're having to play defense so much here, right? That in and of itself is kind of a drag on economic growth, right?
Yes and no. The funny part is that the banks don't mind normalized interest rates. Getting 5, 6, and 7% yields on loans is good. The banks needed that. because during COVID and even before that, the last decade since the 2008 financial crisis, the Fed kept rates very low. So it was difficult for banks to make money, even though their cost of funds was also pushed down. The difference between the two was not helpful. So today, if you ask bankers, do they like writing loans with 6s and 7s and 8% coupons? Yes, they like that a lot. So
I'm
I
sure
guess
they do, but I guess my question is
hmm,
that they're going to be able to make less loans at that level because there's just a
yes,
greater percentage that can't qualify, right, or can't take
correct.
that on, and
You
therefore
see
there's
that in
less.
mortgage lending. Remember the point you made about the size of homes, the value of homes going up? We
Mhm.
make fewer larger loans today.
Yeah,
Absolutely.
so isn't that reduced total loan volume essentially sort of a drag? In other words, we just don't have
Yes,
as much flowing out there as we did before.
that's right. And that low income family, again, policymakers are afraid of deflation, Adam. In the 70s and the 80s, my parents used to go out and buy houses during recessions. I would fix them up, paint them, cut the grass. We'd rent them for a little while, and we'd turn around and sell them. This was Washington, D.C. You could double your money on a house in 10 years. Talk about inflation, right?
Wow, smart folks.
Right, but that was, Bethesda, Maryland in the 70s and the 80s. So today we've squeezed that lower third of homeowners and households out of home ownership. And it's a big problem. To your point, just the inflation in home prices has pushed the conforming limit for Fannie Mae and Freddie Mac loans over $1 million in high
Isn't that
price
crazy?
markets. It's $1,000,001 in Westchester County, New York, where I'm speaking to you from today. So that doesn't help homeownership. And again, it shows you that inflation is an endemic problem in the United States, and it's particularly linked to the fiscal problem. But nobody wants to talk about that because Americans are all about today. We don't worry about tomorrow so much. And I think that's unfortunately part of the backdrop of this discussion.
Okay. So let's try to take this into the like so what phase. Okay, so we've just sort of talked about a lot of the macro environment here. What do you think this translates into for the regular retail investor? And it's the folks that are watching this channel, Chris. Like what should they be preparing for? Is it a recession? Is it just a grind through, type of environment? Do you worry at all about kind of the high historic levels of valuations we see in the markets right now? Is there a correction risk, or is it clear skies from here? What are you seeing?
Well, it's always different, right? It's difficult to compare today with the 70s and the 80s. But what I would tell you is that it's possible to have both inflation and deflation at the same time. So I think you're going to have inflation in consumer prices and services, really anything that you need from healthcare through to food and other types of services. The cost of labor is going to continue going up because we have to pay people more. It's the only way they're going to survive. We can't do what we've done for 40 years and suppress wages and then pretend inflation is low, right?
Mhm.
That's unfair to the least of our society. We've got to take care of that. And you saw with Nixon, he tried to index prices because they had
Mhm.
an inflation problem back in the 70s, remember? He took a page from Salvador Allende down in Chile. But I think what I would tell you is I'm worried about certain asset classes like commercial real estate. You are going to see the consumer roll over in the next couple of years, but I don't think you'll see a big reset in the financial markets or housing until probably 2027 or 28. As my friend Stan Middleman likes to say, misery on the eights. And I have a biography of him coming out in September from Forbes Books. And, he's been watching this movie for 30 years. He's pretty good at predicting these things. He's one of the biggest government lenders in the United States. So Stan tends to have his finger on the pulse of the consumer in a very, very direct and profound way. And most of the other lenders I work with some of the biggest lenders in the country, will tell you the same thing. They know there's a problem out there with consumers. Why? Because 80% of the payoffs today on mortgages are from people selling their homes. They're taking the equity off the table. They can't afford the house anymore, and they're selling. That's not good. 3, 4 years ago, 80% of those people were refinancing their homes at
Mhm.
very low interest rates. So at a 6 or 7% interest rate, many of them say, well, I'll take the money and go rent. And I think that's a troubling sign, because what it means is down the road, there's going to be fewer buyers for homes, and that means prices will eventually correct. See,
Okay.
we always assume that supply coming in is going to be the destabilizing factor in home prices. But what if instead this time it's demand?
It's demand. Yeah.
Right. To your question, I think that's the imponderable right now.
Okay. Let me ask you this. So, we talked about government debt. We talked about the state of the consumer. On the corporate side, we have this maturity wall, right? We've got several trillion in corporate debt that's going to re-rate between now and end of 2027 or whatnot, getting us right up to the eights there, right?
Yes.
So there's analysts who say, look, that's going to pinch corporate profits as, unless for some reason interest rates have come down an awful lot by then, a lot of these corporations, their debt's going to re-rate at maybe like a multiple, right? Like the 2x what they're currently paying for it. If we have the situation where we have a weakening consumer, there's a worry that as corporations get pinched, both because of weak consumer spending and then an increased debt service cost, one of their survival techniques or tactics is going to be, hey, I got to jettison some workers here. And then you get into that kind of vicious cycle of recession where you lay people off and they further constrict their consumer spending, which pinches corporate profits even more.
That's
So
right.
could that kind of accelerate the timeline to the eights if that were to start happening?
I think what's going to happen over the past couple of decades, Adam, what have corporations done? They've levered up using debt, progressively cheaper debt, and they bought their equity back to enhance shareholder returns. The Fed just passed all the banks on the stress test this year, which I find incredible. And now they're going to go out and buy more shares back and have bigger dividends, which is great. But I think what you're going to see is corporations are going to be redeeming debt and issuing equity, because the equity is going to be cheaper. And this may tend to keep equity valuations somewhat subdued, simply because we're reversing a corporate finance trend that's been going on for years. Going back to Alan Greenspan, we've been using progressively lower interest rates to goose nominal growth, not really real growth, but to keep the party going, right? And corporations, if they were astute, took advantage of this. Every time the Fed dropped interest rates, they came in and refinanced their balance sheets at lower and lower rates, and they bought back stock. So imagine if we now have to reverse that. Share repurchases become share issuance on net, right? They'll buy stock back, but they'll be selling more, or they'll be selling preferreds, for example, and they may have to redeem debt and de-lever their balance sheet simply because, like you say, the cost is too high. There's another class too, by the way, the private equity funds and various companies that are sponsored by Wall Street funds. They financed a lot of growth during COVID at zero interest rates. These firms now have to go out and refinance their balance sheets. And it's going to be difficult, like you said, because if we're talking about 7s and 8s and 9s, that's very different from a 2%.
Yep.
The other issue is, during COVID, people were buying commercial real estate on assumptions of returns on their investment that were just totally unrealistic. Today, we have more realistic assumptions, but unfortunately, that pushes the value of the building down. This is what we call the deflationary math of cap rates in commercial real estate. So I think that's another issue, which is that if rates are going to be higher, and indeed real rates for long-term are going to be higher, then we're going to change the way that companies and developers finance these projects, and that may require more equity. The regulators certainly want more equity. There's no question there. The question is, can the borrowers come up with the cash? This is the big question in commercial real estate today.
Okay. Well, so as we wrap up here, Chris, where do you see the opportunity here, or what counsel do you have to the regular investor looking to navigate this road ahead? We just talked about a lot of different landmines laid out in the road ahead here. Are there particular areas that you see as good ways to play opportunity here, or is this just a time for defense?
I think that over the last few years, we've been playing a game as investors that was largely driven by short-term factors and momentum.
Hmm.
So, for example, the banks. In 2020, everybody got out of the banks, including me. I sold my common, but I kept most of my preferreds. And indeed, when people thought the world was ending, I bought more because they were cheap. So I think as an investor, you got to realize that fundamental investing hasn't worked too well in recent years.
Yep.
You've got to be cognizant of what the crowd is doing. So classic case in point, NVIDIA. I like to have a really strong fundamental base in my portfolio with income. So I
Hmm.
love bank preferreds and I like to buy them cheap. On the other hand, though, when you see that the winds have changed, you should take advantage of it. So let me give you an example. The best performing bank stock in 2021 was Western Alliance, a mortgage lender that had essentially bought one of the best mortgage lenders in the country from Apollo, AmeriHome. They ran a couple 100%. Then they collapsed when interest rates went up because volumes in the housing sector dried up. In the last year, the stock has gone up 75%. In fact, if you look at the better performing stocks in financials over the past 3 months, they've been mostly smaller names. The big guys were doing it back in the end of last year, January, February timeframe. But in March, April, May, all of a sudden, some of the smaller names, customers, Ameriprise, these are little banks compared to JP Morgan, but they ran. So my point is that on the one hand, you want to watch interest rates, economic fundamentals, but you also have to think to yourself, what are managers doing? What are they buying? What are they not buying? I think a lot of managers have decided that NVIDIA has run its course and it may be time to take a little hiatus from tech. Well, what are you going to buy? I think you're going to buy defensive stocks, frankly, because the chance of a consumer recession is only going to increase as we go forward. The consumer is tired. They've been through a lot. Interest rates are up. Credit cards are 24, 25%.
Mm.
So, in terms of how that consumer takes care of their family, meets their needs, pays for college, everything else, it's going to be a more difficult environment going forward. So for those who can be in equities, thank God, because that at least gives you some hedge from inflation. But I worry about the rest of our society because they don't have that protection. And we have to start thinking about ways to protect their income, or we're going to have a political problem, Adam. It's very simple.
So, Chris, I'd love to talk more about that with you in a future show here because that deserves um, a lot more time than in the last 30 seconds of an interview here. And it's something I talk a lot about on this channel.
Yeah.
And I don't know, one of the questions I've sort of been asking a lot of late is it possible that maybe the bigger crisis we should worry about in the future is not a financial one, but a social one, right? Where so much
Yes.
of the dispossessed, rise up. So, but anyways, I'd just love to invite you, in a future discussion to really make the time to have that discussion properly.
Yeah.
Well, look, this has been wonderful. I'm so glad that we finally were able to get you on the channel, Chris, and I'm so grateful that you were so flexible with my internet went out.
Anytime, Adam.
For folks that have really enjoyed this conversation and would like to follow you and your work, where should they go?
Well, I write a lot, as you know. I publish the Institutional Risk Analyst, which is my blog. We focus on financials very much, but also markets and the Fed and interest rate policy. I'm very active on Twitter under RC Whalen, and I also write a column for National Mortgage News and get into the weeds on housing finance, which is great fun. But it's an area that's so important to the economy, and yet most Americans don't understand it. Most Americans can't tell you how to price a mortgage loan, which is the most important transaction they will ever make.
And
So,
isn't it crazy? It's another thing we can talk about when you come back on in the future that our education system does such a horrible job of teaching just basic practical financial literacy, right? That
yeah.
I would wager to bet that nobody watching this video was given a course in high school or college where they said, "Hey, look, one of the biggest financial decisions you're going to make is buying a house. Here's how a mortgage works.
But
Here's how you
this
go
is the
shop for one."
American system. We depend on agents who work on our behalf to do this stuff for us, so we don't have to become experts on all these things. The question is, are those agents really doing what they're supposed to be doing? Are they acting in good faith? That's the
Right.
big question.
And we don't give people enough practical knowledge to be able to gauge that, right? They're just
Yeah,
lambs when they go into the
but
process.
look, America's about sales. I always think of that wonderful vignette in "Oh Brother, Where Art Thou," where John Candy is beating the hell out of his luncheon companions before he robs them. And that's that. Or whether we're talking about the deficit, how do we solve the deficit? National sales tax. Focus on the point of sale. So unfortunately, when you do that, you always have people that take advantage of those who don't understand what they're doing. And I think that's the big challenge for our society. How do we protect the market economy without killing it, right?
Yeah. Yeah. All right. Well, okay. All right. So much to talk about when you come on next. Real quick, you mentioned 2 books. So that you have a book, it sounds like, coming out later on this year. And then I
Yes.
think you have another version, a new version of your book, Inflated, coming out next year. Did I get that correct?
Yes. That's my summer fun. Yeah. This September, Forbes Books will be coming out with my biography of Stan Middleman, the founder of Freedom Mortgage. It's called Seeing Around Corners. It's a great book. Because Stan is an authentic American entrepreneur. He was broke when he started, and he now owns one of the largest family-owned companies in the United States.
Okay. Well, when that book comes out, get an open invitation to come back here on this
Oh,
channel
yeah.
and tell the audience about it and tell them where they can go get it. And if they want to get the current version of Inflated, just available wherever books are sold?
It is, but don't do that. I've been correcting typos. I wrote that book in 2010, and it was a crazy time, as you may recall. We were all broke. And then I did Ford Men a few years later. The newsletter team at Agora in Baltimore laid it out for me. It's perfect. I have never found a single typo in that book. So it just shows you that newsletter publishers are the best editors.
Okay. All right. Well, then everyone should hold off and wait to get the new one when it comes
Yes.
out next year.
Well, I have a new forward by David Kotok. Gotta wait for that.
Okay.
We talk about fishing.
All right. Well, look, as we wrap up here, I've got one last question for you, Chris, but real quick before we get there, folks, if you've enjoyed this discussion with Chris, would like to have him come back on at some point, maybe end of summer or whatnot, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And Chris, I don't want to put words in your mouth, but one of the things I took from your outlook there was that it's going to be a rougher road to navigate going forward. We're going to have to probably return more back to active forms of portfolio management versus the passive trends that worked pretty well for the past decade. So I highly recommend, as I do every week on this channel, that folks, unless you've got a really good track record of managing your own portfolio to date, that you proceed forward under the guidance of a good professional portfolio manager who understands all of the macro issues that Chris has mentioned here. If you've got a good one who can do that for you and then execute that plan, fantastic, stick with them. If you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the short form at thoughtfulmoney.com. It only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible, position as prudently as possible for what may lie ahead. All right, Chris, last question for you is, you obviously have had a very successful career. You've built up just an extremely impressive body of knowledge in terms of how the markets, the banking system works, et cetera. What's one important lesson you've learned along the way in your career that you think is worth sharing with the audience here? This could be something that a gem that a valued mentor shared with you. It could be a lesson you just didn't learn until the school of hard knocks just beat it into you over time. Any bit of advice to share?
Well, you should always challenge power. People in political office are trying to do their best, but they often have to make a lot of compromise. How do you challenge power? You read books, go back to primary sources, and try and give yourself a broader understanding of issues than you get from the newspaper every day. Because the media homogenizes and summarizes everything. And by doing that, they leave a lot out. So if you really want to understand the world, you have to have a broader context, I think, than simply depending on primary media sources. I spend my time reading really strange financial documents, so that helps me. But as an old friend, Elliot Janeway, was a dear friend of my father's when he worked at Time Inc. He said, Chris, go work for a receiver. That's how you're going to learn about life, going through somebody else's problems. And I did. I actually worked for 2 receivers in the past. And my God, there is nothing like going through a failed company to teach you about life. That's really how you learn.
Wow, that's a fantastic answer. Provides a lot of validation that you're saying that with a bookshelf chock full of books behind you. You remind me, someone who gave a somewhat similar answer to that question that I asked said that you read an article on the internet, right? It probably took the person an hour, maybe to write it. You read a book, it took them a year to write it and might encapsulate, years worth or a lifetime's worth of knowledge and thinking. And so, so many of us on the internet are so used to just going from article to article to article, feel like we're educating ourselves. It's very important to do those deep dives to really get the true story on a lot of these topics, especially the ones that are complex and nuanced.
That's right. That's right.
All right. Well, look, this has just been wonderful, Chris. Thank you so much. Like I said, love to have you back on in the future whenever you want to come back on the program. Can't thank you enough.
Thank you, Adam.
All right. And everybody else, thanks so much for watching.